In this tracking video, we want to talk about the value of paying a tax on the seed versus the harvest. One of the things that has happened over the last 30 to 40 years is that we've been encouraged to put money into retirement accounts pre-tax, or in the case of an IRA, to put it in after tax, but then get a deduction. But 401ks have become the primary source of retirement for most people in this country, and as a result of that, we are deferring or postponing tax in the future. And there are pros and cons to the process, so what we want to help people understand is the difference between paying tax on the seed versus tax on the harvest. The seed being your contributions and the harvest being the retirement dollars that you take out. So let's take a look. What we have on the screen here is an account that someone is putting $6,000 a year into the account, and it's earning 6% interest. And over a 30-year period of time, well, from age, say, 35 to age 65, we'll put in $180,000 in that. Then, if it were going in pre-tax, then you would be saving the tax on $180,000. So let's just take a look. $180,000 times 30% tax. That's $54,000 that you would pay, or that you would save in tax that you would normally have to pay if you had a program. So let's compare that to what you will pay while you're in the distribution phase of the process. We have that $500,000 in an account that is still continuing to earn 6%. Now, upon retirement, you decide to pull out $30,000 a year, which would be about 6% of the account. So you're taking the interest out first. And you do that for a period of 30 years. You retire at 65, and you pass away at age 95. That means that you would have withdrawn from your account $900,000. So let's take a look at the tax on that. $900,000. Again, in the 30% tax bracket. And some people think they're going to be in a lower tax bracket when they retire, but we will address that subject in another video. Where taxes more than likely are going to be higher for the vast majority of people, or higher than they think. 30% of 900,000 should be 270,000. Let's just see if we can get to do that. $270,000. Now remember, you saved $54,000 going in, but you paid $270,000 on the withdrawal phase. Or there's one other thing, and that is, if you were lucky enough to never have withdrawn any principal, if you were always able to get 6% and you only took $30,000 out, you still have $500,000 in the account. If it's in your 401k or an IRA, it has never been taxed. And so someone will have to pay the tax on that $500,000. It may not be you, it may be your spouse, or maybe your heirs as you pass it on. But the net result is there's another $150,000 or more in taxes due onto the $207,000. So the reality is that you pay much more in taxes over your lifetime during the withdrawal than you save going in. So what we suggest to people is that they take a look at that scenario and determine what might be the best for them. In most cases, we recommend that you use tax laws applying to a Roth 401k or a Roth IRA. So you're moving the accounts from always being taxed to never being taxed.